On Thursday, March 17, 2022, after the close, FedEx reported lower than expected quarterly results, citing continued labor issues and the Omicron outbreak as factors. They indicated second-half ground margins would fall short of internal objectives. FedEx reported earnings of $4.59 per share. However, that missed analysts' call for a profit of $4.64 per share, according to estimates by Institutional Brokers Estimate System. In extended trading, FedEx shares sank 3.5%, down to $219.90. Ouch! In fact, FedEx fortunes in the stock market have been sinking all year. If you had purchased FedEx stock at the beginning of January at its high of $266 per share, you'd be down about $38 per share based on yesterday's close of about $228. That's a loss of almost $40 per share, about 15% loss of equity. But will FedEx be able to turn things around? Will they be able to overcome their labor issues and start producing better returns for share owners moving forward? Is it time to buy FedEx? Hello and welcome to Stock Market Fever. Today is Friday, March 18th, and FedEx was down in post-market close after running up to $228 before their earnings announcement. The bid post-earnings announcement was about $220 for a loss of $8. What was in the announcement disappointed share owners and would-be investors. What's been happening at FedEx? During the COVID-19 epidemic, e-commerce shipments drove income for FedEx and United Parcel Service, but FedEx has been less effective than its competition in turning that additional business into profit. FedEx has been rerouting about 600,000 packages a day due to labor shortages around September of 2021, but though they have begun to alleviate these shortages, FedEx Chief Operating Officer Raj Subramaniam stated that volume was lower than expected owing to Omicron. As a result, we anticipate that our second-half ground margins will be lower than our previous forecasts and will not exceed double digits, Subramaniam added. As Omicron faded, volume recovered, according to executives. Despite this, researchers have noted a widening difference between UPS and FedEx ground operations. You're working at an 8% profit margin, give or take. The UPS truck is on its way to 12%. You used to be so much better, Scott Group, a Wolf Research analyst, said. FedEx warned in January that Omicron illnesses have resulted in pilot shortages and shipping delays in its Airplane Express division. FedEx had previously stated that personnel shortfalls in its non-union, contractor-based ground segment were causing earnings to suffer and deliveries to be delayed. In the tight labor market in the United States, UPS's unionized workforce has been a standout performer. UPS employees have greater compensation and benefits than their non-union counterparts who deliver for FedEx and Amazon, which have had difficulty recruiting and keeping drivers and other important personnel. So what do expert analysts think will happen moving forward? Do they advise buying FedEx? Prior to the earnings announcement yesterday, Schwab Equity rated FedEx with a C hold rating, noting a negative quality grade but a positive value grade. Analyst CFRA had a strong buy recommendation since March 13th, with a 12-month target price of $335. On the other hand, Market Edge in February downgraded FedEx to an avoid rating. Can't anyone agree on FedEx ratings? And what are investors posting on social media? On Yahoo Finance Board, one investor observed, "Not a bad earnings report in my opinion. Revenues are up, capital spending of $7 billion compared to the prior forecast of $7.2 billion. Operating income of $1.3 billion, up 32% year over year, up 37% on an adjusted basis. Not bad, FedEx. Negative, expenses are more than expected, leading to a smaller earning per share than expected. not at all bad overall. But an investor with a less positive take noted, missed. Recession in weeks with stimulus done, massive inflation of food, energy rents mean much less Amazon and other non-essential items for FedEx. 200 will be tested this quarter in my opinion. We personally believe that FedEx earnings are in a catch-22 situation. If as a result of inflation, rising interest rates, and rising oil prices, our economy starts to slow, that could hurt FedEx as it has noted by lowering the number of packages being shipped. On the other hand, these same factors could ease the labor market somewhat, making it easier for FedEx to recruit and retain employees. But at what cost? So where does FedEx go from here? How will they overcome the challenges of reduced volume and labor shortages? When will they absolutely, positively deliver a turnaround in their financial performance? In theory, a slower economy could mean lower wage growth, but with inflation still nowhere near being under control, might there still be pressure on FedEx to pay higher wages? Thus, given the contradictory forces at play during times of stagflation, it appears that FedEx might benefit in the cost area of labor, maybe, and perhaps will hurt in the area of overall revenue. Therefore, due to a lack of clarity in management's being able to deliver improved return on capital, we will not recommend buying FedEx, nor do we recommend selling it. Trading at around $220, it is priced at about 13 times earning, which seems to be a reasonable price. But what do you think? Do you believe management will be able to bring the higher revenues being achieved by UPS to FedEx? Which way do you think FedEx stock will go? Do you recommend buying, selling, or holding? Please leave your comments below and be sure to like, comment, and subscribe to Stock Market Fever for future stock market analysis and alerts.